Good morning, afternoon, evening. It's a pleasure to be here with you again today. It's a beautiful sunny day, at least where I'm at, and I thought it would be a fantastic time to brighten up your week with a discussion on the death tax. The death tax, legally known as the estate tax, has been getting quite the buzz lately in the circles of the living, and it tends to be a little confusing, so I'm going to break it on down for all you out there interested in dying profitably. Before I get into the death tax, or the estate tax, I'm going to define two other taxes that will help us make sense of what's to come. The first of these is the inheritance tax. This is not an estate tax, and not all states have an inheritance tax. Briefly stated, an inheritance tax is a tax on the transfer of property after death, while the death tax, or estate tax, is a tax on the estate itself. For the sake of simplicity, an inheritance tax is a tax on the person who is receiving money or property, and the death tax is a tax on the person giving the money or property. Some states have inheritance taxes, others don't. The federal government always provides a death tax. The second relevant tax is the capital gains tax, which is a tax on the increased value of money or property over time. Example time! Say you buy a $10 stock in the Charmin toilet paper company, and 10 years later that same stock is worth $100. If you cashed it out, you would have to pay a capital gains tax on the $90 increase in the value of the stock. Same thing if you buy a condo for $20,000 and later sell it for $30,000. That's a $10,000 increase in value that the federal government will be salivating over come April 15th. Now, I know there are some ways out of the capital gains tax for the sale of personal residences, but I'm just trying to give you a basic idea of the capital gains tax, so back off, okay? Now, those out of the way, let's dive right into the death tax. The death tax is imposed on the estate of a person after he or she dies. Myth number one about the death tax is that it applies to everyone. It does not. It only applies to estates with $5 million for singles or $10 million for couples, which affects, about 2% of Americans. So, unless you or a close family member is wealthy, the death tax probably won't affect you. But, if you die and you are worth $5 million as a single person or $10 million as a couple, then the federal government will tax 35% of your worth before it can be passed on to your heirs. Anything you leave to a spouse or charity is exempt from the death tax. But anything left to children, siblings, friends, parents, hamsters, drug dealers, or anybody else will be taxed at 35%. 35% is the rate from 2011 to 2013, I think. But the limits and percentages go up and down like all taxes. Since 2001, it's been from 55% to 46% to 35%, so be sure to check the current death tax rate before dying in order to get the most out of your death. Myth number two about the death tax is that it affects one's entire estate. It does not. It only affects the portion of the estate above the limit, which again is $5 million for singles and $10 million for couples. These numbers too are good from 2011 to 2013-ish. The numbers shift from year to year, but the principles don't. For example, if you're an unmarried person worth $6 million walking across the street and you get crushed repeatedly by a rogue tractor driver who is texting while farming, the first $5 million of your assets will go untaxed and $1 million will be taxed at 35%. Again, estates left to a spouse or charity are not subject to this tax. Moreover, just like with the income tax, you can get tax credits, and some of your expenses can be deducted from your total worth, so that if you have a $6 million estate, but you can come up with $2 million worth of deductions and credits, then the value of your estate can be reduced to $4 million for tax purposes, and that would exempt you from the death tax altogether, because you would then be under the $5 million limit that triggers the death tax. I'm not going to get into what qualifies as a deduction because that's just too much information, and go see a tax lawyer, geez. Now, if you think you're slick and you're just going to avoid the death tax altogether by giving away all your crap towards the end of your life so that when you finally do croak, you'll have a $0 net worth, forget about it. The government already thought of that. It's called the gift tax. If you give any amount over $13,000 to someone within the span of 1 year, it will be taxed at 35%. So, you can have the gift tax at 35% while you're alive, or the death tax at 35% after you're dead. The choice is yours. The last major aspect of the death tax is a principle called stepped-up basis, and this is where the capital gains tax issue comes back in. Part of the estate tax law is that after your estate is transferred to your heirs, they receive your estate at its current value rather than its original value. In other words, the value of your estate at the time of your demise becomes the new original value regardless of what you paid for it during your lifetime. For example, you bought a house in 1970 for $50,000. In 2011, you get trampled by a herd of wild cows and you die with your house now being worth $90,000. Before the death tax, your heirs would have had to pay capital gains taxes on the $40,000 increase in property value as soon as they received it. After all, your estate appreciated $40,000 since 1970. But with the advent of the stepped-up basis clause in the death tax, the past would be erased and the government would just tax the house at 35% off the top when you left it to your heirs, but the new base or original value of the house would be stepped up to the $90,000 it is worth in 2011. So if your heirs sold your house at $90,000, they would owe no capital gains taxes on the $40,000 increase in value since 1970, and they would pocket the $90,000 free and clear because the new original value of your house is now $90,000. And thus, for tax purposes, the selling of your house at $90,000 would be breaking even. However, if your heirs sold your house for anything above the new stepped-up value, say $100,000, they would still owe capital gains taxes on the $10,000 profit that they would make on the sale of the now $90,000 house. But at least it's better than paying capital gains taxes on all gains since the purchase of the house in 1970. So, the difference between having a death tax and not having a death tax is the difference between your heirs receiving all 100% of your estate upon your death but paying capital gains taxes on the increased value of your estate versus the government taxing your estate at 35% off the top before it goes to your heirs and then eliminating the capital gains tax burden that your heirs would otherwise have had to pay. So let's recap. The estate tax is a tax on the transfer of estates worth $5 million or more after death. The first $5 million goes untaxed and everything above that is taxed at 35%. After this, the value of the estate is then stepped up to its value at the time of your death before it is transferred to your heirs. Again, the percentage and the limit amount may change, but the principle remains the same. Okay, now you know what the estate tax is. If that's all you needed to know, you may shut down your computer now and enjoy a cup of tea until death, when you are able to pass your estate on to your heirs. If you just can't get enough of the death tax, you just can't get enough and you want to hear arguments for both sides, like is the death tax a good thing or should we get rid of it, please watch the next video on the subject entitled The Death Tax, Part 2, Arguments for and Against.